Ben, I want to bring you in here. You've got a somewhat unique perspective on ETFs. You see a lot of the flows in and out of this business. You're engaged in a lot of the plumbing of the business, the internal. Broadly, how are you seeing all this volatility impacting the ETF community? For example, we've seen the issuance slow down. It looks like that way to me, at least in response to the volatility. Is ETF issuance slowing down? I mean, what are you seeing around all this volatility in the ETF world?
Well, product development continues to run at a hot pace. So last year, we were at an all-time record of about 50 ETFs a month. And we've seen that slow this year to about 35 ETFs a month, which is still, on a historical basis, incredibly high. So our queue at BNY Mellon continues to be as large as it ever was for new products coming to market. So what are we seeing? Well, most of those products are really actively managed. So the majority of the products that are in the queue, and were also launched over the last couple of years, on our platform, and I think it's fair to say industry-wide, were actively managed. And if you consider sort of non-market cap weighted or non-traditional market cap indexes, that number gets up to higher than 90% if you think about that in terms of a broader definition. But it's coming from all angles. So we're seeing that product development from new issuers. We're seeing it from existing issuers who are trying to position themselves in this part of the market cycle. And also, we're just seeing plain old new entrants coming to market. And just in the last few weeks, we've seen Morgan Stanley, AllianceBernstein, Matthews Asia, and others all coming to market or announcing their intent to come into the ETF market. So we expect that to continue to run high, but the volatility will cool things off a bit.
I want to go back to actively managed ETFs in a few moments, but I'm going to ask you, John. In the last few weeks, I've had numerous guests on ETF Edge with alternatives to stocks and bonds. Everyone's got an alternative, everything from leverage and inverse, which we talked about, to defined outcome ETFs. I notice you've launched the Astoria Inflation Sensitive ETF, PPI, at the end of 2021, which looks for companies that would benefit from inflation. So when I look at this, I see a lot of commodity companies in here. I see Nucor, I see Marathon Oil in there. You've told me before there's a bull market in inflation-sensitive assets, but there's a recession for long-duration assets. Can you kind of explain that? What's your market view right now where we are?
Sure. So if you just think about what we talked about before, Kathy Wood, these are all long-duration, strategies, companies that are going to make their cash flow 10, years from now, maybe even longer. Maybe some of them are not ever going to be profitable. So the market doesn't like that. And as you eloquently point out on the show, that fund is down 50% year to date. The NASDAQ is down 25% year to date. What's working, what investors want is knowing like defined cash flows up front, right? So things that pay a dividend, value-centric stocks, they're in vogue, right? Obviously, commodities, energy equity, commodity equities, they're benefiting because inflation is rampant. So PPI, which is the Axis Story Inflation Sensitive ETF. So Story is a sub-advisor, Axis, Matt's firm is the advisor. We thought that would be beneficial because when we looked around the ETF landscape, there weren't too many ETFs out there that were inversely correlated with stocks and bonds that would provide a hedge. So when I look at alternatives, I think, and I've been on the show before, Bob, where we've said always carry alternatives. Think of it like insurance, right? Don't leave your house without the umbrella during a rainstorm, right? Because the cost of that umbrella is going to skyrocket, when you're out in Manhattan trying to look for the umbrella. So things like PPI are up 7% year to date, 8%. NASDAQ's down 25, S&P's down 15, right? So that's an alternative in my eyes. We also have this long-short ETF, BTAL. That's up 15% year to date. So, I think you asked about my active management views, where we are in the cycle. Ben just mentioned that. I think there's still a lot of risks out there in the marketplace. I still think that you want to be tilting away from tech and growth because I think those are longer duration strategies and the market's not liking that. And you want to be tilting towards value, dividend-paying stocks, hedge your inflation risk. That's what our firm is doing, Story Advisors, for our investors.
Yeah. So I guess this is for anybody, but I'm wondering about this. Ben, maybe you have an idea, John or Matt. In the last few weeks, I have seen very large volume in leverage and inverse ETFs, particularly around the triple Qs. Maybe this makes some sense. I mean, these products have to rebalance every time, just like everybody else in the leverage and inverse world. But there's been some comments recently that these particular leverage and inverse ETFs might be able to exacerbate volatility on extreme days. Does anybody have any thoughts on that? I don't know, Ben, if you have any thoughts on that. We've seen this particularly around triple Qs, really, really big volume in these leveraged inverse ETFs.
Yeah, from my standpoint, this is a movie we've seen before. And certainly, we've seen that volume tick up in leverage and inverse ETFs. We've also seen ETF volume honestly explode across the board. So if you look at not just those products, but just if you take an industry view, I think the number was around 16 trillion in total volume. And if you annualize that out, we would see a record year. I think it would shatter the record from ETFs contribution and volume. And there has been this narrative out there, around ETFs' role, in pushing the markets around. But certainly, we have not seen, sort of any new evidence, certainly at this point in the cycle that, that's in fact happening. It just seems to be that, again, investors are increasingly choosing to use ETFs, whether it be to speculate a tool or a way to get exposure at this point in the market cycle, and that the data is incredibly clear on that.
Yeah. Any thoughts in particular, Matt, on this? I mean, you're sort of in this business right now, the leveraged and inverse ETF business. This has been controversial for years, leverage and inverse ETFs. It seems like the SEC wants to believe that it may play a part in some of the volatility. It's very hard to actually, say definitively one way or another. But the SEC certainly seems to be sort of interested in this potential idea. What is your response to them when the head of the SEC says we're concerned about leverage and inverse products in general?
Yeah, so I think whenever you come out with stuff that's innovative, especially kind of first of its kind type of stuff, like we're trying to do, I think you've got the regulators trying to kind of stay ahead of it and wrap their head around it. There's so much out there. I mean, you could argue that investing in RK is dangerous. Look at where it's gone from February 2020 and until now. To me, more tools are better. And, so don't focus as much on that, but maybe focus on the education, focus on, the qualifications of the people who are selling the tools. But, I wouldn't restrict investor access to a lot of these tools. And I think, as more and more of this comes through, and I think as the regulators see that, no, these things aren't really doing anything to the marketplace, I think what's going on right now will eventually just blow over.
Yeah. John, any thoughts on that? I mean, you're a guy actually on the front line. You actually have to recommend portfolios of ETFs. Most people who are involved in leverage and inverse ETFs say, well, these are for active traders who have to know what they're doing. They're not for long-term investors. What's your view on leverage and inverse ETFs, John?
I'm kind of along the lines of Matt, where, more tools are better than less. They're already out there. So, adding additional tools on the margin, in the spaces that Access is launching, I don't think that that's bad. I think that's good. It always creeps up in client conversations, right? There's just this inevitable itch to kind of get exchange-traded leverage. And I think the sponsors have always done a good job educating the people. The fact that liquidity spikes when volatility spikes, I think that's a good thing, right? I'd be more worried if there's like, $50 billion in leverage and inverse ETFs, volatility spikes and liquidity, declines. So, I spent 20 years on the trading floor, Bob. I've seen the hedging mechanics of how these issuers hedge. I don't think there's a problem. I think the market always likes to kind of pin, something on these firms. But in the end, I think they're just doing what they're intended to do. So it's kind of buyer beware, right? Make sure you know what you own.
Yeah, that's for sure. Ben, one of the trends we're seeing, and you mentioned this, is more actively managed ETFs, particularly in bonds. Is this volatility accelerating the creation of more active ETFs? What are you seeing this year?
Without a doubt. Again, certainly we've seen, a number of actively managed products come to market, specifically in the fixed income arena. And honestly, this was anticipated. It really goes back a couple years ago to the ETF rule that was passed by the SEC that frankly made it easier for issuers to come to market also quicker. And here we are a couple of years later, and that's exactly what we're seeing. And it's well positioned for this point in the market cycle. So really, we've built some technology to help facilitate that, to further accelerate that sort of product development sort of flywheel. And what we're seeing is quite a bit of innovation. Now, certainly issuers like John and Matt and many others are coming to us with really a wide range of complexity that we're able to package inside an ETF and do so in a very low cost, efficient manner. And so it's running the gamut from what I would call traditional active fixed income strategies. And these are money that is coming out of mutual funds just simply into an ETF structure with something similar, and very innovative products that are out there, a couple of which we just mentioned and others, right, that are looking to play, this point in the market cycle that are really targeted for this moment.
Well, Ben, what are other products coming to market to address volatility? It's a little head spinning, frankly, following this as a journalist. We have target outcome products out there that use options to provide a market hedge, for example. That is really difficult to explain on television. I wonder kind of what the target is for that kind of product, for example, but it's one of many products that are out there right now to sort of address this problem of stocks down and bonds down.
Well, it's still difficult to explain on television, but I would say that, you are seeing no shortage of these products. So it's, I think, Bob, the target or defined outcome products, absolutely seeing quite a bit of interest from investors. Again, they're providing some kind of downside risk protection. But again, these are sophisticated products that, do require explanation and careful consideration by investors. There are other products that are coming to market that are, like PPI, but others like from issuers like Simplify, a product like PFIX or SPD that are trying to, provide some kind of other inflation hedge or a way to profit in this type of environment. There are others who are also trying to provide products that really are some kind of volatility dampener or offset to the rest of the portfolio. So these are products like managed future strategy or other ways to play the interest rate curve like IVOL and others that are ultimately designed, again, to provide some kind of non-correlated exposure or simply a way to, again, try to find some yield or some alpha at this point in the market cycle.